The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important.
We don't have plans to close full offices and tell people to work from home. No. We want people to come into the office.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 24th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 2022. And there's plenty more commentary from Fed speakers today. The hawk takes flight while the Bank of England's chief economist, Andy Haldane, is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. And JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from our discussion with Barclays' Jess Daly and much more from the Qatar Economic Forum. So the Fed may tighten by the end of 22 and decide on trimming bond purchases in the next few months. That's according to Atlanta Fed President Raphael Bostic. Now, he was echoed by his colleague Robert Kaplan, who said he sees a decision on tapering coming sooner rather than later. Some of our top guests at the Qatar Economic Forum weighed in also on the risks around inflation.
The U.S. economy is really on fire.
Developed markets like the U.S. and Europe are further ahead.
Worried that we'll see a second half of the year where the economy is running really hot, first and foremost the U.S. economy.
I do think that prices are going up, and we do see it in our companies.
And that will have spillover and spillback effects into the global economy.
But I don't think it's anything to be alarmed about at this point.
The chances are higher as opposed to lower that this is ongoing inflation and that the Fed will need to adjust.
This is, in our view, a transitory phenomenon.
I am concerned about inflation overshooting by more and for longer.
I think if you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy.
Well, joining us now to talk about inflation is Klaus Baader, Societe Generale Global Chief Economist. Klaus, I have many questions for you. First of all, it doesn't seem that the market is, repricing what we heard from Fed officials yesterday, which is actually we could have an interest rate increase early as next year. I mean, that's pretty soon and pretty unexpected.
Yes, it is. We've had the last FOMC meeting offered big surprise because not only was there a move of the median expectations towards a rate hike in 2023, that wasn't the case previously, and there is a not insignificant minority on the FOMC which now sees an interest rate hike in 2022. Now, the difficulty, this may still seem a long ways away, but it has immediate relevance because if that were to be the case, then the Fed's tapering would have to be very quick, much quicker than, for instance, we expect, I think, much quicker than most people in the market expect, simply because you want to have finished asset purchases by the time you raise interest rates. That's at least been the preferred strategy, and I think breaking that strategy could potentially instill a lot of uncertainty and a lot of volatility in markets.
All right, Klaus, keep that thought because we're also going to talk about Bank of England. Klaus Baader of Societe Generale stays with us. Let's also bring in Lizzie Burden about what we're expecting from the Bank of England, set to announce its policy decision today against the backdrop of rising inflation, a growing global debate on the path for monetary policy, and a slowing reopening of the UK economy. Lizzie, there's actually so much going on for the Bank of England, and they really need to try and, I guess, walk the path of not freaking out the markets, while at the same time, making sure that they kind of, juggle everything in terms of growth and inflation.
Exactly. Well, so we're expecting a unanimous decision to keep interest rates at 0.1%, but an 8-to-1 split on bond buying with Andy Haldane, the chief economist, again, the sole dissenter, the lone hawk in his swan song, to pare back stimulus. He's likely to cite this rise in inflation above the bank's 2% target, but the question is how temporary that'll be. We've had lots of economists bringing forward their forecasts of when the first post-pandemic rate hike will be. Bank of America, Credit Suisse. Interesting note from Berenberg this morning. They've said the bank could surprise markets today by signalling it'll end planned asset purchases in August instead of December. But as you say, the bank will have to deal with this tension between its recent position and the markets.
So, Lizzie, is there a chance actually the Bank of England moves before the Fed? I mean, in terms of timeline, how quickly could that happen?
Who knows? I mean, we've had all these positive economic signals in the UK, manufacturing, housing roaring ahead, payrolls surging, consumers upbeat. But at the same time, in the UK, you have to acknowledge that unemployment, we don't know what's going to happen when the furlough scheme ends. We don't know if the government will be able to get the Delta variant under control in time to reopen the economy as planned. So that's going to stop the bank being as hawkish as it may want to be. In the future, it may want to wait until August for clearer data to be clearer about what it's going to do.
Lizzie, thank you so much. Our Bloomberg UK economy reporter there, Lizzie Burden. So let's get back to Klaus. And Klaus, I don't know whether it's a race, right, between who moves first, but it feels like, I don't know, you know, the first that moves may have a first mover advantage.
I would think it's a first mover disadvantage, actually. You know, I think that none of the central banks really want to break cover here. I think they'll want to move, you know, more or less in tandem, because, you know, the big risk is that, for instance, let's say Bank of England clearly steps ahead of the Fed, stops its asset purchases, as a reporter suggested, as early as this late summer or autumn. I mean, chances are that sterling would absolutely surge, and I don't think that that's what politicians want. You know, I think. While what was said is absolutely true, I think what we also need to keep in mind is that, you know, the UK economy was probably the worst hit economy out of the advanced economies, and it's still the one that is furthest behind the starting position before the crisis. So the UK economy has a long, long ways to recover. You know, it's basically as hard hit as Spain. And so I think in that sense, the case for a very early move by the Bank of England is not very strong. But, you know, let's not forget, the Bank of England has already tapered, and they have managed to do so in a very undramatic way. And so I think, actually, they've been quite successful.
Klaus, what are we misunderstanding, actually, about how some of these central banks operate, or how the markets misinterpret or interpret some of their communication strategies?
Well, you know, I wouldn't necessarily say that the market is inept here. The fact is that, you know, central banks have, and all of the main central banks, I wrote this up in quite some detail in our latest quarterly outlook. If you look at the evolution of central banks' macroeconomic forecasts, whether that's for GDP, whether it's for unemployment, whether it's for inflation, they have all improved quite dramatically since, let's say, call it the darkest hour, roughly a year ago. And yet the monetary policy stance is completely unchanged. And that there's an increasing tension between this much better economic outlook and a completely unchanged monetary policy stance. And so those two, I think, have to be aligned again. And I think the Fed did a pretty good job aligning it with these changes in the dot plot that were published at the previous FOMC. So I don't really think, and I wouldn't blame the central banks that they're getting the communication all wrong. They're just dealing with a very fast-moving economic outlook. And because the deltas, the changes have been so enormous, the shifts are also enormous in the outlook, much bigger than they have been historically.
Yeah, Klaus, what are you expecting for treasuries?
Well, we expect a continued gradual increase in long-term interest rates, and that's very much a global view. You know, we think it won't be by year end. We're actually going to have positive bond yields. Would you believe it? Bund yields. I'm sorry, positive bund yields. That'll be something. We haven't had that for a while, but yeah, I think interest rate, the bond markets are going to normalize, and it's going to make a difference that central banks aren't major buyers of those assets any longer.
Yeah, Klaus, calls for celebration for the banks for positive yields. Klaus Baader there of Societe Generale joining us this morning. Now, coming up, an avalanche of opportunities. A Blackstone chief executive, Stephen Schwarzman, says the risk of U.S. capital gains tax increases could actually lead to an explosive growth in potential targets. More from our conversation with him at Bloomberg's Qatar Economic Forum. Up next, this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now more from the Qatar Economic Forum and a conversation with Blackstone's chief executive, Stephen Schwarzman. He says the risk of an increase in U.S. capital gains taxes may lead to an avalanche of opportunities as corporate owners look to cash in ahead of any legislative changes.
We've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents, we believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sectors is promising, especially if you really targeted a certain segment within technologies. And I think it's the sectors is have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Well, that was the Qatar Investment Authority's Chief Executive Officer speaking at the Qatar Economic Forum with Stephen Schwarzman. Now, as you could hear, the Blackstone Chief Executive sees an avalanche of opportunities coming from an increase in U.S. capital gains tax. He says the investors want to sell things before their taxes are much higher for selling the same thing potentially next year. So let's discuss taxes and investments with our guest this morning. He's Klaus Baader of Societe Generale. Klaus, when you look at some of the growth models, some of the inflation models, given what we're seeing with COVID-19, how much does the tax regime actually change, I guess, the trajectory of growth or just some of the companies?
I don't think dramatically. I don't really think that is the key thing. There is, of course, a very legitimate question, which is, we're right now, we have absolutely massive public sector deficits. And how are we going to get away from those public sector deficits? Are we going to get back to a sustainable path of public finances? And is it going to require significant tax increases? I think it may well not. And the reason is that the deficits are as large as they are currently because governments have dramatically increased the sensitivity of the public sector deficit to GDP. And so as GDP recovers, and it is recovering much faster than anybody has expected, that the public sector finances are also going to improve more than the long-run relationships between GDP and the public sector deficit would suggest. And so I'm not massively worried about this. Now, don't get me wrong. In the US, there is very much a discussion about making the tax system more equitable. And that is something that I certainly wholeheartedly agree with. The fact that a lot of the biggest US companies don't pay any taxes, well, that's outrageous. And so the US tax system really needs an overhaul, and a big one, and Joe Biden's on the job. And so I think that's good. But no, I don't think that that's really the key issue. For me, the key issue for the nearer term economic outlook is all around households. Households and the behavior of consumers is front, back, and center of this recovery because they are chock-a-block with savings. Chock-a-block.
But Klaus, so how do you see it? This would point to what, higher inflation globally?
Well, yes, than it did in the base case. As everybody is revising up their growth forecast, including us, everybody is also revising up their inflation forecast. Now, that doesn't mean that I'm looking for some explosion in inflation, but I also don't think that we're going to return to the super low inflation environment that we were in. I'm definitely in the camp that doesn't say. It isn't, we called our global economic outlook, the latest one, we called it inflation transitory until proven permanent. Now that's, it's a good title. I didn't come up with it. It's a great title. I didn't come up with it. But the point is, it's not so much about is it going to be permanent, but rather is inflation going to be of the kind that is going to force central banks into action? That's really the question.
Klaus,
I don't think we're forever in a high inflation. Sorry, yes.
No, but it's very difficult for inflation. I know it depends on what you measure, but I was sent a photo, for example, of a croissant, a coffee yesterday for £6. I know I live in an expensive city, but actually if people need to put up their prices to make up for, COVID-19, for the pandemic or whatever, they then don't lower them after a while, right?
Correct. No, but but you have to differentiate between what you're now talking about is really characterizing effectively a one-off increase in the price level. And so you get for a period high inflation, but then you go back to the previous inflation trend. When people talk about permanent inflation, what they talk about is that you get higher inflation leading to higher wage demands, which leads to higher inflation. And so you get a wage price spiral, but it might as well, in my view, be called a price wage spiral, because I think very often wages react to prices and not always the other way around. So you got to differentiate between these one-off price pushes. Are prices rising at the moment? You bet. If you look at the US core PCE or headline PCE, you just look at the level, it dipped a little bit at the beginning of the crisis, but now it is rising much more above the trend than it undershot the trend right at the beginning of this crisis. So, that everything is becoming more expensive. There's this in the US, they talk about a reopening premium, is not solid evidence that we're in a high inflation regime.
All right, Klaus, always great to catch up. Thank you so much. Klaus Baader there, Societe Generale Global Chief Economist. Now, coming up, plenty more from the Qatar Economic Forum. We'll hear from our interview with the Barclays Chief Executive, Jess Daly, about the return to work, and also from BlackRock's Larry Fink about the prospect of a digital dollar. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China is suing Australia, the World Trade Organization, over anti-dumping measures on some Chinese goods, further ratcheting up tensions between the two nations. The measures target Chinese products, including wind towers and stainless steel sinks. Earlier this week, Australia said it would appeal duties imposed by China on its wine exports. Now, women are more likely to develop persistent symptoms after a coronavirus infection, according to a study of 500,000 adults by Imperial College London. Overall, about 1 in 3 people reported at least one symptom lasting 12 weeks or more, with the likelihood increasing with age. Now, sources say the US is set to ban some solar products made in China's Xinjiang region over suspected human rights abuses. The move, which is expected later today, would mark the Biden administration's biggest action yet against Beijing's alleged crackdown on the Uyghur Muslim minority. Xinjiang produces roughly half of the world's polysilicon, a key material for solar panels and semiconductors. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, Londoners are snapping up luxury homes as lockdown measures keep wealthy foreign buyers away. We speak to Niccolo Barattieri, the chief executive of Northacre, a property company that develops luxury apartments in London. That's coming up next, and this is Bloomberg. Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 22, and there's plenty more commentary from Fed speakers today. The hawk takes flight. The Bank of England's chief economist, Andy Haldane, is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. And JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from our discussion with the Barclays' Jess Staley and much more from the Qatar Economic Forum. So good morning, everyone. I'm Francine Lacqua here in London, and welcome to Bloomberg Surveillance Early Edition on Thursday, the 24th of June. JP Morgan says it may require employees to get vaccinated as it ramps up its plan to get staff back into the office. This follows decisions by Morgan Stanley and BlackRock to bar workers from the office unless they've received a shot against COVID-19. Now, I spoke yesterday with the Barclays chief executive, Jess Staley, about his plans to getting employees back to work. He said that while the bank will facilitate flexible working, there's no replacement for face-to-face discussions.
Today, I'm sitting in the office, and we have an executive committee meeting right after my call with you. And pretty much everyone's going to be in and sitting around a table, which I think is a very important dynamic. So one of the things that's interesting, we went back and looked at what were our employees actually doing pre-pandemic. And I think businesses were already moving down the pathway to having flexible work hours. And it's very important that we let a single parent leave on a Tuesday afternoon at 2 o'clock to take a son or daughter to a doctor or to a sporting event. That flexible working, I think, was already building up prior to the pandemic, and obviously the pandemic has accelerated a lot. So I think people will be flexible. I would be surprised if most people are in more than 4 days a week. But one of the challenges of the technology era is you can look at your iPhone at 10:30 at night and start texting away. So I think technology has actually increased the working hours, although maybe less so in the office.
Would you ever just consider actually selling some of your real estate, like office buildings, because of the way we work post-pandemic?
I think there will be, a rationalization of our real estate footprint. But I would say it's more normal course. So no, we don't have plans to close full offices and tell people to work from home. No, we want people to come into the office.
What's your take on the City of London 6 months after Brexit?
I think the City of London has done a remarkable job. I think I think the banks have, again, been very constructive. I think it has increased the dialogue with government in a very positive way. And I, go back, you can walk on a trading floor of the investment bank. But what I find the most energizing is to go to the local branch where I live in London and to see the dedication of the people behind the counters and engaging with walk-in customers day in and day out. And they've been magnificent. And, you know, banks have not closed. They stayed open. And they've done their service to the communities where we live. And so I'm pretty encouraged by where London is, and London will be fine.
That was part of my conversation with the Barclays chief executive, Jess Staley, as part of the Qatar Economic Forum. Now, London's luxury housing market is largely relying on locals as lockdown measures keep wealthy foreign buyers away. Sellers of the priciest properties had been looking forward to the summer after Prime Minister Boris Johnson chose June 21st as a likely day that COVID restrictions would be lifted. But then the government delayed the easing by at least a month. According to data from Lunres, homes in the wealthiest areas of London are selling at the fastest rate in 7 years, but that's not translating into higher prices. Well, Northacre is a property company that develops luxury apartments in London. Niccolo Barattieri, Northacre chief executive, now joins us. Niccolo, as always, thank you so much for giving us a little bit of your time. And I like our regular catch-ups just to have an idea of what the luxury property market in London does. So we were thinking it was getting better with foreign buyers coming in. When are you expecting them to come back? And what's the situation like at the moment?
I think we'll have to ask Boris of when they're coming back, to tell you the truth. I really don't know in the short term, but we're expecting them hopefully in the fourth quarter of this year. I think what you're seeing in that, as you know, and as we've spoken in the past, you know, the high-end space is characterized by having a strong interest from foreign buyers who at the moment are not able to come in. What we're seeing is that local buyers are stepping in, and as Lunres is saying, prices are not translating in an upward trend, even though there's activity, and that's because local buyers are more price sensitive than the international ones.
So what are the kind of expectations around the end of the stamp duty? Does that make a difference at all at those price levels?
Not really. I mean, in the high-end space, you know, the end to the stamp duty holiday that's going to happen imminently is going to make no difference. It will help. It has helped quite dramatically in zones, you know, 2, 3, and 4, and 5 in central London. In fact, you've seen pricing up between 5 and 7% in those areas in the last 12 months. But in central London, zone 1, pricing is actually down 2% during the last 12 months. So no, it doesn't make a difference to our buyers.
Niccolo, what about inquiries or also sales to people coming from Hong Kong?
You know, we've spoken in the past that there has been strong interest from Hong Kong, from China, from Asia in general in the last 3 or 4 years. So even though the market was difficult, they were really the big buyers and the supporters in this market. You know, they have gone quiet now purely for the inability to come and actually see the homes that they want to buy. So we are bullish in the medium to long term purely because, you know, homes are at the forefront of people's expectations at the moment and their luxury purchases. But at the moment, until they can come, I think it's going to be quiet also on the inquiries front, especially from Asia.
And Niccolo, overall, for the luxury property market in London, do you see it, you know, has it bottomed out? Can it only get better from what we saw last year?
Well, look, I think we've had 7 difficult years, right? The market peaked in June 2014, and since then you've had a price correction of around 20%, depending in what area. There are a couple of takeaways that I think that are important. The first is that, you know, in these 7 years, you've had 3 prime ministers, you've had Brexit, you've had COVID, you've had the changes in stamp duty that have doubled the stamp duty level at this price point. So a lot has been thrown to the market, and actually this market has been very resilient if you take into consideration all these things. Having said that, you know, you're in an environment where you have low rates, you've got fiscal stimulus, you've got lockdown savings, you've got limited housing stock, and you've got the fact that actually after this pandemic, people are looking at their houses as something that is much more important than it was before. So yes, we are bullish going forward. Lastly, what people also have to understand is that construction costs have gone up quite considerably. You have shortages of labor and materials, and you have borrowing costs that even though rates have come down in the last 7 years, for developers, borrowing cost has actually gone up. So new units that will be coming to the market will not be cheaper than they are now.
Niccolo, your longer-term forecast, so there's a couple of surveys out there saying that if we look at the prices that we had for London prices in 2014 from the prime market, that we could reach again those levels in 5 years. Because of Brexit, because of other influences, how likely is that?
Well, look, you're talking of having growth of about 4% a year. Going forward, I think it's very possible. You know, the market at this level is very finite. If you think that, you know, over £5 million there were transactions, there were only 300 transactions last year in central London. So, you know, it doesn't take much to move the needle quite considerably. In 2014, that number was around 650. So all it takes is a couple hundred more buyers to come into the market, and you'll see prices moving quite quickly. So yes, I think it's very possible.
Niccolo, when things reopen, where, you know, do you have inquiries again from buyers from a certain part of the region? Where do you expect the bulk of sales to come from regionally?
I think that Asia will dominate the market. I think the Chinese have been very active even in the last 7 years, and actually they in a certain way have graduated from buying in zones 5 and 4 and so on, and they've moved into zone 1. And you've seen that they've made quite a bit of difference. They are the vast majority of the market, especially in the last couple of years.
Niccolo, as always, thank you so much for joining us. Niccolo Barattieri there, the Northacre Chief Executive Officer. Now, coming up, the U.S. is set to ban some solar products made in the Xinjiang region. It marks the nation's biggest step to counter alleged human rights abuses in China. We'll have the full story shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Siemens has raised its financial targets and announced its first share buyback since 2015. The German industrial giant will buy back as much as €3 billion of stock over a 5-year period starting from next year. That is as the company's new chief executive pivots towards software to boost shareholder returns. Now, sources say bullish. A cryptocurrency exchange backed by a group of billionaires, including Peter Thiel, is in SPAC merger talks with a Far Peak acquisition. The deal could value bullish at nearly $12 billion, with an agreement possible in just the next few weeks. The final valuation could change depending on the price of Bitcoin. The world's biggest maker of Bitcoin's mining rigs is suspending sales of machines for spot delivery globally to prop up prices. Bitmain Technologies says it has stopped selling new equipment after top-tier rig prices plunged by about 75% since April. China's crackdown on crypto mining is causing more and more miners to abandon their operations and dump machines on the market. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the U.S. is poised to bar some solar products made in China's Xinjiang region after allegations of forced labor. The move marks one of the Biden administration's biggest steps yet to counter alleged human rights abuses against the country's Uyghur minority. Now, joining us now is Bloomberg's chief Asia economics correspondent, Enda Curran. So, Enda, first of all, this feels very significant. Were we expecting it?
Well, look, it's another hawkish step by the US administration. Francine, Xinjiang is the source of around half of the world's polysilicon. It's an important input into semiconductors and solar panels. So the thinking is that this move is bound to have a spillover effect, not just in the terms of China-US political relations, but also in the industrial side of things. So there might be some reshuffling of supply chains as companies look to source their solar products from elsewhere. Now, we've already had a rebuttal from the Chinese Foreign Ministry this afternoon in Beijing. They pushed back against this measure. They condemned it. And of course, we know that China consistently considers Xinjiang to be its own internal red lines, and it criticizes other countries for interfering. But as you said at the start, it is a push by the US against China on the allegations of human rights abuses and forced labor in Xinjiang. And it does kind of continue the the narrative that we left off with the Trump administration and the kind of hawkish move that we were seeing during that presidency too.
So, Enda, what does it actually tell us about the wider U.S.-China relations?
Well, I think we'll have to see the details of the policy when it's formally announced, of course. But it does speak to the idea that President Biden is continuing to pursue something of a hawkish approach. We don't have the full specifics or the contours of his China policy just yet. I mean, we've had some courtesy calls between the officials. We've had that meeting in Alaska, of course. We don't yet quite know, though, the full parameters of the Biden-China policy. We do know that he went to the G7 a few weeks ago, and he did try to push a hawkish line there against China with some success. We saw some pushback from Europe, but nonetheless, President Biden does seem to be shoring up some alliances when it comes to the US-China story. So I think at the very least today, while some people will say this move was more modest perhaps than some hawks are pushing for, you'd have to say President Biden continues to pursue a hawkish approach when it comes to China, even if the mood music has changed a little bit from what he inherited from the last administration.
Thank you so much, Bloomberg's chief Asia economics correspondent there, Enda Curran. Now, Larry Fink says cryptos are not important, but he acknowledges that the digital assets inspire young investors. Up next, we discuss the BlackRock chief executive interview with our very own Eddie van der Walt. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's talk Bitcoin. And the cryptocurrency has been touted as a possible inflation hedge, institutional investors are increasingly turning away from it. Among them, BlackRock chairman and chief executive Larry Fink, who spoke with us at the Qatar Economic Forum powered by Bloomberg.
Long-term investors are very unfocused on the tick-tock of the market, the tick-tock of the ups and downs of crypto. I think it's fascinating to watch crypto because it's inspiring a lot of young investors. I think that's fantastic. I think if that inspiration leads to long-term investing, that is a great outcome. But with our focus on long-term investing, and with 2/3 of the assets we manage are for pension funds, the conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important. Could crypto become a really important asset class one day? Sure. But right now, the bid-ask spread, the volatility, it has not led to widespread conversations worldwide. Where conversations I have with governments and leaders is about, should there be a digital currency, true digital governmental currency? That will change finance in a very substantial way. If there was a digital dollar, a true digital yuan, that will change however, that would be much more impactful than any other, like a crypto. But it's something that we look at, some of our investors use as one tool for investing. But it is really about the tick-tock of the market, and that's what public media does. You focus on the moment, the markets, and the ups and downs. BlackRock is focused on the long-term, building long-term portfolios as a fiduciary for our clients. And if we deem crypto or any asset in the world is a great long-term asset on behalf of pensioners worldwide or people building pension funds, then it'll be one of the tools for asset composition. But the tick-tock of the market, the ups and downs of what's going on in any one individual stock or a crypto, it's really unimportant.
Well, that was the BlackRock chair and chief executive Larry Fink speaking at the Qatar Economic Forum. Now, joining us now to discuss crypto and the markets at large, as ever, is the Markets Live Eddie van der Walt. Eddie, always great to catch up. So we've had a wild ride. I ask you and tell you this every week in crypto. What's the next level?
It's a fantastic asset class to watch, isn't it? I mean, because the upside is spectacular and the downside is equally as spectacular. So, look, I hear what Larry says there, and he makes a good point. When you talk to, I'm sure when you talk to big pension funds, as he does, the conversation, Bitcoin will not be the focus of the conversation. But those in the crypto community will tell you, look, that means there's opportunity for growth. That means there's a lot more people that haven't invested in it yet. And this asset class probably isn't right for, the majority of investors just yet at this point. But it's becoming more regulated. It's growing up little by little, and it's going through all of those. We've seen kids in their teenage years. They're turbulent, and I think this is where Bitcoin is now. Bitcoin's in the teenage years, but at some point it's gonna hit the big time. And we're still heading that way.
I love this analogy, Eddie. So, what is Bitcoin going to be when it grows up? Is it what crypto is going to be? Is it Ethereum or Bitcoin?
Yeah, that's a really good question. I think it's a little bit of both. I think for the moment, Bitcoin pulls in the money into the space, and then that money is used by, it also flows to Ethereum and some of the other smaller coins, which then uses it for the, DeFi purposes. In other words, ways of decentralizing finance, of creating new ways of settling contracts and so on. But I think Bitcoin is important for putting money in. And I think Bitcoin has a shot of, in the long term, becoming something like gold. That doesn't mean gold is Bitcoin is gold right now. It means that it is a speculative play on an asset that may someday become a store of wealth. But we're not there yet. Right now, it's very much a risk-on trade.
Eddie, what's your take on inflation? So we heard from the Fed. I mean, are we going to see a repricing of assets yet again? Or was it already priced in?
Yeah, look, the pivot at the Fed is just, it's really going a little bit more hawkish, isn't it? We've got Bostic, Bullard, and there's a number of voices that are just starting to grow more hawkish, saying that, listen, we want to see a rate hike as soon as next year, never mind the slowing of asset purchases. So I think the Fed is catching up with the market a little bit, because the market's been talking, has been saying that inflation is not quite as transitory as the Fed has expected for a number of months now. So the Fed's catching up. But I think here in the UK, the Bank of England's still very much behind the curve, and the ECB even further.
Yeah, what are you watching out for? I mean, the Bank of England, it'll be interesting to see, how the lone hawk votes for the last time, Eddie. But how much more difficult actually is it for the Bank of England, given it's a small, economy, closed economy compared to the US?
Yeah, and the UK is in a different place to the US. Reopening has been delayed again. Furlough scheme is still continuing. We don't really have the answers of where the economy is heading now, and we're losing. In the next few meetings, two of the hawks at the or perceived hawks anyway at the Bank of England. So I think the conversation is at a different place for the Bank of England. I don't know that the Bank of England is behind the curve in terms of where the market wants it to be, but it will definitely be interesting to see what we hear from the Bank of England, and particularly after Andy Haldane goes.
Thank you so much, Eddie van der Veld there from Markets Live. He'll be staying with Early Edition. Stay tuned. We'll continue in the next hour. Matt Miller joins me out of Berlin. Danny Berger here with me in London. This is Bloomberg.
The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated.
The conversation about crypto is a minor percent of any dialogue we have with any company worldwide. It's just not terribly important.
We don't have plans to close full offices and tell people to work from home. No. We want people to come into the office.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 24th. Our top stories today. Sooner rather than later, the Fed's Raphael Bostic and Robert Kaplan say the Fed could start tightening by the end of 2022, and there's plenty more commentary from Fed speakers today. JP Morgan warns that it may require employees to get COVID-19 vaccines as big banks push to get staff back to work. We'll hear from Barclays' Jess Staley and much more from the Qatar Economic Forum. And the hawk takes flight. The Bank of England chief economist Andy Haldane is likely to use his last meeting as an MPC member to push for a reduction in asset purchases. Well, welcome to Bloomberg Surveillance, everyone. This is the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Danny Berger with me in London, Kailey Leinz off today. Matt, I know we're looking a lot at what we heard from Fed officials basically saying that we could have an interest rate rise as early as 2022, but actually we're not seeing a schism in the markets. I wonder whether or how much of it was already priced in.
No schism yet. But we will be watching for one, Francine. We're going to be watching interest rates very closely, going to be watching the inflation versus disinflationary regimes. Do we see a secular shift? We're also looking very closely at who's going back to work. I spoke with Siemens CEO Roland Busch early this morning. He said they're looking for a more flexible solution. So still allowing people to work from home or remotely, as he put it, but also wanting to get people back in the office a few days a week. Let's take a look at what's going on in Asia. Reliance Industries, by the way, is having its shareholder meeting in Asia. They'll talk a lot about work from home as well. They're doing their shareholder meeting, their annual general meeting, virtually for the second time. They used to do it in football stadiums, but obviously the COVID pandemic has been very difficult in India, especially recently. Take a look at what's going on in Asian markets. You see a lot of green on the screen, except for in Southeast Asia, and there you see a lot of red. And the MXAP, the MSCI Asia Pacific Index, isn't doing very well today. If you take a look at the broader market, you see it's up, but only about 0.05%. Look at the South Korean won. It's actually gaining against the dollar. This is a U.S. dollar Korean won, so as the dollar rises against the won, it's falling. As the dollar falls against the won, it's obviously rising. That's why red arrow, but still a green move. And the Turkish lira, I put in there. We think of it a lot of times as European, but I've walked from Europe to Asia and Turkey, so it obviously is spread across both continents. And then you see Reliance right now down 1.25%. Of course, Mukesh Ambani is the richest man in Asia, and he is speaking or has just spoken. You can follow that on our live go, Danny Berger, if you want to watch Mukesh talk. It's very rare that he makes an appearance.
Yeah, but I feel like that move on the lira isn't that exciting. I mean, we've seen crazy stuff happen to that currency, Matt.
Good point.
I mean, not that I want to see more craziness for it. Just saying it could be moving more. When it comes to Europe, though, it is a very positive day. Kind of surprisingly so, considering that we have the concerns around the Delta variant simmering in the background with the EU Commission leaders meeting today. But you have a lot of consumer goods doing really well. So that means you're going to see France, for example, outperform. It's all those luxury companies, the Hermes, the Kering, people still buying handbags, I suppose. But underperforming today is definitely the UK. It's only up 0.2%. And apologies to everybody. I have a very UK concentrated start to my board because we have the BOE today. It's really going to be really closely watched.
I can't believe it's Thursday already.
I know. How did we get here? How did we get here? But look, the market's been waiting for this, and it's still waiting for this, Matt. It's still waiting for this decision. So basically not much movement in the pound, not a lot of movement in gilts that have been pushed and pulled around by what's happening at the front end of the U.S. curve. And continuing to stick in London, you have LME copper down 1%. We saw stockpiles rise by 20% for copper. So that supply side of the crunch, perhaps it is over, and we can see copper come back down. Good news if you're watching for inflation. And finally, Credit Suisse got an analyst upgrade today as the new chair comes in saying, hey, they're concentrating on asset management. That's good news. Finally, want to quickly look at what's happening over in the U.S. We're looking at S&P futures higher by 0.5%. Really, we continue to see overnight. We get this bit. Sebastian Gailey from Nordea says it is a market in stasis. We continue to want to buy the dip. We continue to have that FOMO driving things. Bloomberg dollar spot weaker this morning. U.S. 10-year yields, there are still sellers out there. We're at one spot, 49.70 rather. And I just want to put the VIX on here because we are so close to a more than 1 year low. We're at a 15 handle on the VIX. Not a lot of volatility, but besides that, we are seeing a skew index that is near a record. So tail risks are in, tail hedges are in, Francine, despite the fact that what we're seeing in the VIX is just complete calm. Everybody is just so zen right now.
So zen, apart from the NFTs and the meme stocks,
right,
Danny. I mean, those are not zen, and they're not chilled at all. They're like on triple espressos.
Yeah, everyone wants to buy an NFT. There's one that I'm so excited for today. It's the World Wide Web. We'll talk about it later. I'm very excited for it.
I'm creating an NFT for Surveillance Early Edition. It will be ready soon. Danny, there's a lot to watch out for today at 7 a.m. Eastern Time. We'll get a rate decision from the Bank of England. It's the last meeting for Andy Haldane, the biggest hawk on the NPC. Then lots of U.S. economic data, 8:30 a.m. New York time, including initial jobless claims as well as personal consumption for May and first quarter GDP. Then more central bank action with a rate decision from Mexico at 2 p.m. Eastern time. No move expected, but it comes as more Latin American central banks have been signaling the possibility of tighter policy. And after the close on Wall Street today, we'll also get the results of the Fed's stress tests. It could lead to the big banks releasing billions of dollars in buybacks and dividends to investors. Now, there's also a lot more Fed speakers today. That comes after we heard from the Atlanta Fed President, Raphael Bostic, and the Dallas Fed President, Robert Kaplan, yesterday, both with the view that the Fed may actually tighten next year. So let's get into the markets. All of this with our Bloomberg MLive editor, Eddie van der Veld. Eddie, what exactly is the market pricing in right now? I mean, 2022, an interest rate hike is pretty significant.
Yeah, I think so. And look, if we do get there, that would be a very positive sign for the global economy, just to see, that the economy is ready, has reopened. But, I think there's a lot of COVID fatigue, and people just want to get on with their lives at this point. And if that means people go out and they spend money and they push up inflation a little bit, so much the better. And that would be, I think it would be a very positive thing if they manage to do that. But there's still a lot of water to get under the bridge before we get to next year and those rate hikes.
Eddie, just quickly on Bitcoin, I know you're watching closely the cryptos, and we saw that bounce back to 33,000. What are you expecting as we go forward here?
That was a bit of a surprise, wasn't it, Matt? I mean, Bitcoin had been testing that 30,000 level for a number of weeks, and it felt like if it breaks through there, that we could see a significant pullback to sort of the mid 20,000s. But it didn't happen, and the buyers stepped in. So I don't know. I don't know that the tests at the downside, are done. But even so, this won't signify the end of crypto. Crypto keeps bouncing back from the lows. I think you and I have talked about this rubber bubble before, and I think this is something that's true in crypto. When we see those big pullbacks, a lot of people see that as a consolidation phase for the next run up.
Eddie, I don't know how you can keep so calm watching Bitcoin all the time. I mean, I feel like it's always a roller coaster ride. Eddie, thank you so much. Bloomberg MLive's Eddie van der Veld. Let's go on to what's happening over at JP Morgan, because it says that it might require employees to be vaccinated. It's, of course, Wall Street preparing to return to the office. Joining us now is Tom Metcalf, Bloomberg UK's finance team leader. Tom, does this seem to be the way that banks are leaning towards in terms of requiring employees to have a vaccine?
Yes, I think that's fair. You've obviously had JP Morgan send out this memo on Wednesday, basically mandating employees to fill out a questionnaire on their vaccination status. And before that, you've had Morgan Stanley effectively doing something similar. Other companies, I think BlackRock, are also in this boat. So it does seem to be the direction of travel. And of course, it sort of varies by company and also by region. But it does seem to be that as banks try and get folk back, they're going to sort of be chasing this information, and you probably maybe have a two-step process for unvaccinated employees. They may take longer to be brought back into the office.
Tom, Francine has been super psyched about bank stress tests all week long. All of a sudden today, I don't think she's that into it. But I'm looking at, $160 billion of dividend increases and stock buybacks that could be unleashed by these decisions. What are we expecting?
Yeah, this is the big news in finance today. To be honest, I think there won't be too many surprises. The banks seem to be doing well. There's no kind of huge shocks in the horizon. I suspect there'll be, probably cautious statements. But, I think, maybe the great unlocking is about to begin.
Tom, thank you so much, Tom Metcalf there. Could I just say, on the surveillance NFT, actually for early edition, I have the first bid, guys. I have someone coming in, remains anonymous, for $500, the first bid. So this is really, we're branching out merchandising for surveillance.
Do we tie ownership of surveillance to that non-fungible token?
I'm sure,
if the price is right?
Am I allowed to bid on this? I know I, kind of come on now and then. Is it like a conflict of interest if I bid on?
We're selling it.
No, I want to own it though. What if I want to own it? All right, well, let's go ahead and check in some of the pre-market movers.
Tom Keene on this.
Yeah.
Definitely not.
Co-creator of surveillance. Yeah.
This is for the early edition. I'm sorry, the bid is for the early edition.
Yeah. I don't want to say that that's worth more. Just going to, leave that one, let that sit. Anyway, looking at Tesla this morning, it is up 3% pre-market. Really interesting to look at the move of Tesla in context with the U.S. ban on some solar panels coming out of China. Tesla, of course, highly involved in this space. Is it the solar ban or is it an Elon Musk tweet? Elon Musk tweeting about the Starlink IPO that Tesla shareholders will probably get priority on that. So that could be moving it as well. Now, moving on, I also want to talk about some of the meme stocks this morning. We have Torchlight that is moving higher by 3%. They got hammered over the last 2 trading sessions, losing half of its value earlier this week. So it's coming back from that. It had offered up some new shares, so a slight bid there as well. Finally, Rite Aid, they have earnings later on today. Rite Aid has a very high short interest to it, about 15%. The implied volatility on Rite Aid as well is really high. That's about 15% of a move that we're expecting to see. So shares moving higher ahead of that, up more than 7%. Maybe some of these short sellers out there think that they could get washed out of the market, that, you really can't continue this gain, you really can't continue any losses considering how high the shorts are. So, Francine, that might be part of the reason why that this is moving higher this morning. But, of course, we'll just have to see what happens with those earnings later.
Danny, so much to look at today. Coming up next, Peter Oppenheimer. He is Goldman Sachs Chief Global Equity Strategist. We'll talk inflation, we'll talk stocks, we'll talk diversity as well. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua and Danny Berger in London. Kailey Leinz is off. And I'm looking at a chart that shows the differences in valuations between groups of bank stocks regionally. Peter Oppenheimer is our next guest. We're going to talk to him briefly, but he has a great note out saying that you may see a change in leadership in terms of value and growth, but also a split regionally as value and growth kind of meld together. We have seen a real outperformance of U.S. bank stocks. For our listeners on radio, I'll tell you, U.S. bank stocks is represented here by a white line, and it's just taken off as a percentage of book value right now at 137%, whereas FTSE 350 Banks Index and the Eurostoxx Banks Index, they're both floating around 61, 62, 63% of their book value. So still way below book value. And my question to Peter, Chief Global Equity Strategist at Goldman Sachs, who joins us now, is do these European banks start to catch up now as we recover from the pandemic and people start looking at underperformers regionally?
Yes, hello, Matt. Good to be here. I think the European banks are quite a compelling value case. Now, of course, they've been cheap for a very long time, and many people saw them as being really uninvestable in much of the decade after the financial crisis. They had to raise more capital, moves to negative interest rates, crushed their margins, and then the pandemic hit and you saw provisions for loan losses. But now they're becoming much more cash generative. They have had a strong bounce from the lows as many people have moved into more cyclical and value parts of the market. But from a valuation perspective, there's still a big catch up to make up for the shortfall with US banks. Now, the conditions are not exactly the same. The US economy is recovering more quickly, although Europe is catching up on that basis. But also the shift in interest rate expectations in the US, which you were talking about earlier, is helping the US banks in a way that we're not yet seeing really in Europe, given that rate rises are still not really a realistic prospect for some years to come. That being said, we do think that they're becoming cash generative. They're in a position to pay dividends again. They look very cheap. And I think that's one of the areas that we would be overweight in the European market.
Peter, I know in your note you also talk about the clear distinction between growth and value likely to fade. What does that give way to?
I think more of an eclectic mix, frankly. We need to look at this in context. If you look at the cycle that followed the financial crisis, for at least 10 years, we saw a very bifurcated market environment in which things became very factor-driven. Growth strongly outperformed value in every region. And of course, partly reflecting that, the US equity market massively outperformed other equity markets as well because it had much more exposure to growth. Now, why this happened had a lot to do with ever lower bond yields, and that pushed up the relative valuation of long duration assets. It was also a very growth weak cycle, particularly outside of the US, given the many problems that followed the financial crisis, the sovereign debt crisis, collapses in commodity markets and so on. So growth was quite scarce. But then we also had the tremendous outperformance of technology companies and their earnings. And I don't think we're going to see such a bifurcated market now. Sorry.
Right. So what does it mean where you see the best value from now on?
So here we see a mixture between deep value areas of the market. Banks we were just describing would be one. Commodities, energy, mining would be another similar area where we think there's strong cash flow being generated and some good valuations. Right. But also some of the more defensive growth parts of the market are starting to look quite attractive. They were hit as you got the longer duration stocks selling off a bit in recent months with rising inflation expectations. So we think it's going to be a bit more of a mix. And I think also from a geographical perspective, much more of a mix in performance rather than such a clear outperformance of the US.
So with that, if you don't have this clear growth versus value, you have some other things in there. Does that mean it's a stock picker's market now, Peter?
Yeah, very much so. You know, we sort of think about a kind of framework really where most cycles are defined by different phases of development. Now, the initial recovery from a bear market, what we call the hope phase, is nearly always driven by very sharp rises in equity prices and valuations as investors start to price a recovery. That nearly always is led by cyclical and value stocks. But as you go into the next phase, the growth phase, where the actual growth comes through, you tend to get lower returns in general and a much more mixed return across sectors and factors. And it becomes really the area of alpha opportunity. And that would be really our call, that we're going into a period now where there's less beta opportunities, less steep rises in equities more broadly, less clear distinction between factors and sectors, but a much better opportunity set for alpha and stock picking.
Peter, thank you. Peter Oppenheimer there, as ever, with some wisdom on global equities, chief global equity strategist at Goldman Sachs. Now, coming up later, an exclusive conversation with the former New York Fed president and Bloomberg opinion columnist, Bill Dudley. That's at 7:30 a.m. in New York, and this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off. Now let's get straight to the Bloomberg First World News. And John McAfee has been found dead in a Spanish prison cell shortly after it was announced that he would be extradited to the U.S. to face charges of financial crimes. The creator of the McAfee antivirus software had been jailed in Spain since October on U.S. tax evasion charges. Now, Spanish newspaper La Vanguardia reported that he appeared to have taken his own life. News from Singapore in the last few minutes. The country is planning the first COVID vaccine shot for most people by the end of July. Singapore will also offer the vaccine to anyone older than 12 from July the 2nd. And President Biden has ousted the regulator of mortgage companies, Fannie Mae and Freddie Mac, replacing a Trump administration appointee. The move follows a ruling by the U.S. Supreme Court, which rejected a core part of a lawsuit brought by investors in the companies. Shares in Fannie and Freddie each plunged the most in intraday trading since 2013. So there is, of course, quite a lot going on in the financial space, and this was just one of the one things that actually will see a change under the Biden administration.
Yes.
Yeah,
many
definitely.
things will probably change.
Yeah, and of course, the lingering question, the Biden administration, is what happens with infrastructure. Is it smaller than we originally planned for as well?
Yeah, the big one to watch a little bit later as well. Coming up, the BOE decides. We'll speak to Simon Wells, HSBC Chief European Economist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off. Matt, I don't know whether you want to talk about the stress test, the Bank of England inflation, or whether actually we just go rogue and talk about JP Morgan warning employees that they may need to be vaccinated to come back into the office.
You know, this was going to be my what to watch. So now I'm probably going to have to change it. But I think it's fascinating,
We can watch
Francine.
it twice.
Well, exactly. I think you might see more and more companies start to come out and require vaccinations. And then, of course, you're going to see pushback from people who feel that impedes on their freedom somehow, and then they're going to want to not get vaccinated. So this is why I'm sure someone like Jamie Dimon is going to try and be very delicate about it.
Yeah, I don't know how delicate he has been in the past, actually, through closed quarters. So we'll see exactly if this is a trend amongst major banks, whether some of the chief executives will feel emboldened to be tougher on their staff. Danny, what's playing out in the markets?
Well, I keep coming back to this idea from Sebastian Gailey of Nordea that it's a market in stasis. I really love that phrase because we continue to see resiliency after some of the turmoil of the past week of people wanting to go in and buy. Both Stock 600 and U.S. futures up higher today, 0.7% and 0.5% respectively. We keep seeing that FOMO, that buy the dip, that what happened yesterday we reverse today. But we are seeing copper head lower by more than 1% today. LME copper, we've seen stockpiles rise. Of course, China about to release its vast reserves of metal, selling into the market, pushing that price down, trying to control inflation. And in that context, what's happening in oil is fascinating. Prince Abdulaziz overnight saying that OPEC has a role to play in taming inflation. We're still seeing, though, the global benchmark Brent hold above $75 a barrel. It's been really steady despite some of the commodities falling. I also want to get into some of our pre-market movers as well. So Forest Road acquisition, it's a SPAC. Some Disney executives, Shaquille O'Neal is also involved in this one as well. And Matt, you're going to kill me for this because Shaq's back, but I feel like you're going to hate what I'm about to say. It's a three-way merger. They're buying, well, it's merging with Beachbody and but what else do I call it? There's three of them. It's a SPAC. Does merger not work in this circumstance?
I feel like, you know what, there may be in some sort of, in a Harry Potter book, merger would work. But in real life, there's a buyer and there's a seller of an asset.
But
now,
there's three of them.
I need to visualize the three-way to understand it, but usually it's an acquisition.
Okay. Well, I'll try to figure out who's acquiring who's not merging. Anyway, so that's one SPAC. Another SPAC that's gotten a lot of attention as of late is Clover, up more than 5% pre-market. This one's really fascinating because we had Barry Sturlich, the property billionaire, yesterday in the Qatar Economic Forum saying Clover is an example of SPACs gone awry. It's crazy that this thing has gained so much, and anytime anyone talks down about it, it rallies. Well, that's literally exactly what happened. He spoke ill of it, and it's rallying so far pre-market. Finally, Sprinkler, an IPO. It's social media management software. It had a downsized IPO, but I think because of that, it got a lot of interest once it finally listed. So shares up 8%, Matt.
All right. You know what? My man Curtis has put together a pretty sweet chart for me. Dan Curtis, of course, my charts producer out of New York City. I love his cynicism. I share in it too. Radio listeners, I'll walk you through. Welcome, by the way, on London DAB Digital. What this shows us is the 10-year yield and S&P 500 futures pre and post Fed meeting. Now, of course, it's been over a week, but the point of this is we had some real movement, the 10-year yield jumping and then diving, S&P futures falling and then recovering, and now a week and 1 day later, apparently, I just learned it's Thursday, are right back where we started from, although we do see S&P futures starting to move a little bit higher. I just think it's interesting that all of this, it's much ado about nothing. To quote, I'm going to guess, William Shakespeare. I actually don't know who that is. Not a really literary person. But Francine, maybe you can help me out. What, Avon upon Stratford, where's William Shakespeare? Is that Much Ado About Nothing? Is that him?
It is him. Good job. Actually, when you come to London, I'm going to bring you to the Globe, and the Globe is like the house of Shakespeare. You can actually look at productions by candlelight. I know for a very romantic Matt Miller, that will be perfection. Now, the Bank of England is set to announce its policy. There you go. And the team. Its policy decision today against a backdrop of rising inflation, a growing global debate on the path for monetary policy, and a slowly reopening UK economy. Well, joining us now, Simon Wells, Chief European Economist at HSBC. Simon, I mean, what we're expecting is for the lone hawk, Andy Haldane, as his last MPC, to kind of go out and say, like, we should do it differently. How much attention will that grab?
Well, I think Andy's vote won't grab that much attention in the sense that we probably know what he's going to do. The bigger question, of course, is whether anyone else is going to follow him, given that it is his last meeting. And if you look at the news since the previous Bank of England meeting, it's all pretty positive, really. PMIs very strong. They fell back a touch yesterday, but still at high levels. You've got these pockets of tightness emerging in the labour market. Firms being forced to bid up for labour, permanent jobs.
Uh-oh.
Uh-oh.
Is it just me, or are we losing Simon there?
About 1.5%.
No. Losing Simon.
Simon, we're kind of losing you. You're breaking up a little bit, and so I'll try and fill some time while our techs work on your connection. You know, we were in the danger zone, I felt like, for a moment. Andy Haldane first brought it up, and then we got that Deutsche Bank note from Peter Hooper and David Volkerts-Landau, and Mohammed El-Arian wrote a column for the FT about it, and then a piece for Bloomberg Opinion. And then the Fed, Jay Powell, kind of opened up a little bit of optionality at the last meeting. Maybe a hawkish turn, but basically spreading himself between the outcome-based framework and a little bit of a forecast in terms of what's going to happen in the labor market. And I wonder if that's made it less dangerous now.
Less dangerous. You know, Matt, something that really caught my attention is, okay, so it's very clear that the BOE will continue to be sanguine about inflation. So they have a very similar pattern to the Fed, but it's a very different economy. It's small, it's open, it's an island. And you wonder whether there's a first mover disadvantage or advantage, right? So if you're the first one to talk about tightening, does it mean that actually, it changes your reserves, Danny? And it kind of does go back to the matter of what kind of currency level you need, depending on how you export and import.
Right, but historically, it has been the Fed that moves before the BOE. I mean, that's kind of what the market is accustomed to. So it's no surprise that when the Fed makes more hawkish statements, that you see yields and likewise pound really move according to how those U.S. assets are behaving. But we've known that some of the emerging markets, for example, went ahead and moved before the Fed. So does the BOE follow that? Of course, as we've been saying, estimates and projections are for them not to, that they're going to stay put. And Matt, I mean, part of what goes into here has to be about what's happening in the Delta variant as well.
Yeah, the balancing act. I love the balancing. I mean, it's a nightmare for central banks at the moment. Maybe it is also for some money managers. Simon Wells, I think we have you back.
Adventure.
Reestablished connection. I mean, is this an adventure for central banks, Simon, or is it just a very difficult balancing act?
Well, I've got an old school connection. I kind of missed the middle discussion there. I mean, yes, central banks are facing a balancing act. But the fact is, for such as the Bank of England, that you're really not going to know how much some of the labour market tightness we're seeing now is going to last once support and job retention scheme is rowed back. And that's not going to be until you get data for September, which isn't going to be a few months until after that. But you've got to act now. Different central banks are taking different paths here, of course, depending on their mandates and depending on their priorities. But for the Bank of England, it's not an average inflation targeter. It's using a forecast to target. It cannot afford to ignore some of the signals that it's seeing. So I think today it's probably going to have to come out and point to a few more upside risks from inflation, even if, as I was saying before, got cut off. Perhaps no one's going to join Andy in voting for a reduction of QE just yet.
Simon, I do want to go back to a point you started to make when we started to get a little bit of a dodgy connection, and that's the departure of Andy Haldane. You, of course, spent most of your career at the BOE. We've talked about what it means generally for policy with him exiting, but what does it mean for the bank as a whole? I mean, I'm sure you've run into him a time or two.
Yeah, I worked with him for a long time. Look, this is very much a change for the bank. It's an important point for the bank. It's an important point for Andrew Bailey because, of course, this is the appointment he makes. The other NPC appointments are made by the Treasury. So this is an opportunity for Andrew Bailey really to put his stamp on the bank, decide where he wants to take policy. And he's been around an awfully long time. And, of course, that chief economist really does act as a thought leader for all of the monetary economists in the bank. So it's a key moment. We don't know who it's going to be yet. We had the announcement the other day of the external member. But having been such a vocal hawk, it clearly does change the makeup of the committee slightly.
Simon, thanks so much. Simon Wells there, Chief European Economist at HSBC. Now, coming up, concern about bad loans is diminishing. That's the view from the Barclays Chief Executive, Jess Staley. More from our interview next. This is Bloomberg. This is Bloomberg Surveillance Early Edition, and you're looking live at the Principal Room. Coming up later today, Connecticut Governor Ned Lamont. This is Bloomberg.
We had a record first quarter. The strategy of balancing a wholesale bank or an investment bank with a consumer business anchored primarily in the UK and the US, I think paid off last year. I think it paid off quite strongly in the first quarter. There's been a softening of market volatility, but publicly available information in terms of our business, whether it's advisory or equity capital markets, has been quite robust recently. So we continue to be encouraged about the balance, the balance of our business model. And as we come out of this recovery, and companies are doing better and small businesses are doing better, I think the concern around impairment will come down quite a bit. We have a very large impairment reserve. We were very conservative last year in terms of taking impairment charges. And given what we see right now with the economy, that gives us a lot of cushion.
Part of our conversation there with the Barclays Chief Executive, Jess Staley, as part of the Qatar Economic Forum. Now, the U.S. is set to ban some solar products made in China's Xinjiang region. This marks one of the Biden administration's biggest steps to counter China's alleged human rights abuses. Well, joining us now is Bloomberg's Enda Kern. Enda, how much was this flagged? Is this really the Biden administration cracking down on China, or was this always going to be the case?
Well, I think there are two angles to it, Francine. There is the political angle. It's a clear push by the US now against China in terms of criticizing China for human rights abuses and allegations of forced labor in Xinjiang. There's the economic side of course, which is that part of China is actually home to around half of the world's source of polysilicon, and that's a key input for semiconductors and solar panels, and that might cause companies to shuffle their supply lines and look for a new source of those solar materials. So there's no doubt on the one side it will definitely stoke tensions between Washington and Beijing. Beijing has already pushed back against it this afternoon. And on the economic side, it might force companies to have a look for new sources for these solar products.
You know, the U.S. is now saying that details of the genetic makeup of some of the earliest COVID victims were removed by the Chinese from an American database. How difficult is this saga of trying to find the sources of the virus in Wuhan?
Look, it's clearly one of the biggest political hotspots between not just China and the US, but indeed China and other governments right now, Matt. And look, it's still early days in the Biden administration, but all the mood music and sense is that he's going to pursue a fairly hawkish attack against China. He's not changing too much from what he inherited from the Trump administration. We saw he went to the G7 this month and he tried to get some kind of an alliance there with Europe, with some results in terms of pursuing that hawkish line against China. And that's why we're seeing now today with this expected news in terms of what they will do over Xinjiang and the allegations of forced labor there. And to your point, the ongoing pursuit over the source of the virus, all of these are hot button issues. None of them are going to go away, Matt. And that's why I don't think anyone is expecting, a circuit breaker in the whole China-US standoff anytime soon.
Enda, thank you so much. Enda Curran there, of course, from Hong Kong. Now, coming up, how the possibility of an increase in U.S. capital gains tax is also creating alternative investment targets for the Blackstone chief executive, Stephen Schwarzman. More from our interview next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off today. Now, Stephen Schwarzman says the risk of an increase in U.S. capital gains taxes may lead to an avalanche of opportunities. The Blackstone chief executive spoke to us from the Qatar Economic Forum.
We've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents. We believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sector is promising, especially if you really targeted a certain segment within technologies. And I think it's the sector have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Well, that was the Qatar Investment Authority's chief executive speaking at the Qatar Economic Forum with Stephen Schwartzman. Now, we should note that Qatar is an underwriter of the forum. Right. It's early in the morning, so here's a look at what else we're watching today. And I know, Danny, I've been waiting for the story all day. You're watching NFTs.
Yes, I am. Okay, and total transparency here, I'm not totally sure how I feel about NFTs. Of course, I'm really into the idea of a surveillance one, but this one I think is so fascinating. So it's from Sir Tim Berners-Lee, and he's going to be auctioning the original source code for the World Wide Web. I think that's really cool enough on its own. That auction starts later today, but also the winning bid gets a letter from Berners-Lee, which is, quote, reflecting on the code and the process of creating it, and a 30-minute long video created by a graphic designer that shows the code being written. Matt, I think this is so cool. If I had a ton of money, I would absolutely bid for this.
I still don't get the actual ownership link. Like, is it copyrighted? Do you then own the copyright? Or is it just like a digital certificate promising that it's yours with pictures? I mean,
it's kind of bragging rights, but it's also you get these extra benefits with it.
Well, I like extra benefits, so I'll watch that as well. Speaking of, President Biden has welcomed a group of senators, invited a group of senators back to the White House today to talk about a $560 billion infrastructure deal. It's considerably smaller than what he wanted, of course. We're talking about a spread out over 10 years here. But Senator Rob Portman, Republican of the great state of Ohio, says we are very, very close. So he is optimistic that they'll get a deal. And I guess, you know, the fact that Biden invited them back after talking to them all day yesterday must mean he thinks that there's a way forward as well. So I'll be watching that. NICNG, Fran, as I tell you, NICNG, to watch that on the Bloomberg.
Danny was making me actually think we should do a segment. If you had $100,000, what would you spend it on? I would not choose NFTs, but it'd be a great segment. We start it from tomorrow. I'm looking at the Bank of England balancing this recovery boost against inflation. So we have a full decision guide. What we're expecting from them is really this balancing act to keep the economy recovering whilst limiting inflation, but also limiting speculation about rising interest rates. So we'll see exactly what we hear, of course, from the central bank, but also what Treasury does to maintain stimulus until the recovery here in the UK is more entrenched. So that's coming up shortly. This is Bloomberg.